Hello everyone. In this video, we shall discuss the basic concepts of national income accounting. So, in this video, we are going to discuss the meaning of national income, the concept of value added. We shall discuss GNP, that is gross national product, NNP, that is net national product, GDP, that is gross domestic product, NDP, that is domestic product, GVA, that is gross value addition, then per capita income, nominal and real GDP. Measurement of national income in different methods, that is production method, income method, and expenditure method. So we should know that the methodology used by the CSO, that is Central Statistical Office or Central Statistical Organization, follows the method given by the United System of National Accounts. And all the countries in the world follow the methodology given by the United Nations System of National Accounts, and that is why the GDP of different countries are somewhat comparable, because most of the countries follow similar methodology, and India also uses the methodology given by the United Nations System of National Accounts. And recently, that is in the year 2008, the methodology of national income accounting has been revised, and so the present GDP estimation of India basically follows the methodology given by the United Nations System of National Accounts 2008. Now, coming to the concepts, first we shall discuss the gross domestic product. And gross domestic product is nothing but a measure of production activity. And to estimate the gross domestic product, first we need to estimate the gross value added. And when we say gross value added, it is basically the total value of output minus the total value of the input. That is gross value added. So you deduct the cost of inputs from the total value of the output, and then we get the gross value addition that has happened. And when we want to derive the gross domestic product, we have to aggregate all the gross value addition of all the resident producer units of the economy during the reference period. So here the key words are: GDP is a summation of the gross value addition. And who is doing this value addition? It is by the resident producers, and within a fiscal year and within the national boundary. So that is actually gross domestic product. Again, to repeat, gross domestic product is the summation of gross value addition of all resident producer units of the economy during the reference period. Now, to discuss some more concepts on national income accounting, we shall discuss NDP, that is net domestic product, CFC, that is consumption of fixed capital, and intermediate consumption, because these are the terminology used in national income accounting very frequently. And when we say intermediate consumption, it basically refers to all the inputs used in the production process. And when we said that gross value addition, basically we deducted the intermediate consumption from the total value addition, or the total value of output minus the total value of inputs. So all the value of input is basically known as the intermediate consumption. Then comes consumption of fixed capital. Then this is basically the reduction in the value of fixed capital due to its use in the production. Now, so this is basically nothing but the depreciation, or you can say when we are doing the production, now some kind of damage happens to the machineries, and so the value of the machinery falls, and that's so we say that this is consumption of fixed capital, and that happens during the production process. Now comes the net domestic product. So to get the net domestic product value, we have to deduct the depreciation value from the gross domestic product. Or you can say that we deduct the consumption of fixed capital value from the gross domestic product, and that's how we derive the net domestic product. So net contribution of production activities is given by the net domestic product, which is nothing but the GDP less consumption of fixed capital, or we can say GDP minus the depreciation value. Now, in all the economic aggregates in national accounts, when we derive the net value, we have to basically deduct the consumption of fixed capital from the gross value. Now, just like we have GDP, then we have NDP, that is gross domestic product, net domestic product, gross national product, net national product. So, gross national income, net national income. So, there are different terminologies that we use, and so whenever we want to derive the net value, we have to deduct the depreciation value or the consumption of fixed capital value from the gross value, and that's how we derive the net value. Now, when we estimate the gross domestic product, I told you that it is the summation of the gross value addition by the resident producers. Now, when we say resident producer, who is a resident producer? A resident producer it refers to the producer having a predominant economic interest in the economic territory of the country for 1 year or more, irrespective of the nationality or legal status. So here the question may come that whether we will include all the output produced by the multinational companies operating in India. Yes, the answer will be yes, because they are operating in India, and so the the value addition has happened within the national boundary of India, so that will be added here. But on the other hand, say Indian producers who produce outside the country, that will not be included in the GDP of India. For example, you can say that say Tata has acquired Chorus. Now Tata is producing steel in other country, UK. Similarly, Mittal is producing steel, because Mittal has acquired Arcelor, and Arcelor is in European Union. That their head office is in Luxembourg. So the GDP value of whatever Arcelor produces in other country, that will not be accounted for in India's GDP. Rather, it will be counted in the country where the company is located. So that is basically the resident unit. Then we have GDP at factor cost, GDP at basic price, and GDP at market price. So coming to the first one, that is GDP at factor cost. If the output is measured at factor cost without adding any tax and subtracting any subsidy, then it is called as GDP at factor cost. So it is called GDP at factor cost because it represents the total cost of labor, capital, and entrepreneurship. So we can also say that GDP at factor cost means it is the GDP at factory level. That means whatever output that has been produced at factory level, it has not gone to the market. That's how no tax has been imposed or no subsidy is received, and so that is called as GDP at factor cost. So GDP, just for simplistic understanding, we can say that the GDP at factory level. And so it's not that all outputs are produced in factories. There are also farmers, but we can say that all the output without getting into market, so that the no tax has been imposed or no subsidies received, and that's how GDP at factor. That is actually what it is, GDP at factor cost. And then GDP at market price, GDP at basic price. If the output is valued by including tax, less subsidy on the production, but not on the products. So remember, the union government imposes the union excise, or you can say the tax on the production. So in the present regime, the union government imposes union GST on all the products. Now that union GST is nothing but the tax on the production. State governments, on the other hand, impose a tax on the product, that is basically a sales tax, that is state GST. And so remember that when we are estimating GDP at basic price, we are including only the factor cost plus the GDP plus all the taxes that is imposed for the production, and we deduct the subsidy that is received by the producer. So that is GDP at basic price. Then comes GDP at market price. Now, when we say GDP at market price, then we take the gross domestic product at factor cost plus all the taxes, including export, import, tax on production, tax on sales, and we deduct the subsidies. So that is basically GDP at market price. That means it is the final price paid by the consumer. Okay, so that's how, if you aggregate that, then we will get the GDP at market price. For example, we are suppose producing a cloth, then the product so if you are taking the value of all the cloths that is produced at factory level, then that will be called as GDP at factor cost. Then union government imposes a tax in the production tax or union GST on the cloth. So that's how, and a cloth doesn't receive any subsidy. Then we can say that if you take the factor cost plus the production tax, then it will be GDP at basic price. Then if we add the sales tax, and then the cloth has come to market for sales, then we have the factor cost plus we have the union excise plus we have the state excise, or we can say the sales tax. So that means there is cost of production, then we have the union GST, then we have the state GST, and if the cloth has not received any subsidy, then we can get the GDP at market price. But for some reason, if the cloth price, industry will be subsidized, then we can say that we have the factor cost plus all the taxes imposed by the union government, the taxes imposed by the sales by the state government, and the subsidies will be deducted if at all if the industry has received, and that's how we'll get the GDP at market price. Then we should know GDP at current price and GDP at constant price, or you can say nominal GDP versus real GDP. Now, when you say nominal GDP is nothing but the GDP at current price. Now, GDP measured at current price is called GDP at current price or nominal price. That means you are estimating the value of GDP in the current year's price. To get the value of the commodity, we need to know the quantity and we need to multiply the prices. So here the prices are used for the present year, and that's how we get the GDP at current price. Now, to derive the GDP at constant price, we have to take the base year price. So that means quantity into price. Now here, when we take the price, we will be taking one particular year's price. And for example, now the present GDP estimation uses 2011-12 basic and base year prices. So if you want to derive the GDP at constant price, then a quantity of 2020 output multiplied by the price of the 2011-12. Okay. So then only you get the GDP at constant prices. That means basically we are adjusting for the price, the changes in the prices. That means what we are saying, that if some commodity is 100 rupees today, what was the value of this commodity in the year 2011-12 or in that particular base year. So that is basically GDP at constant price. So it is if it is measured using the price that prevailed in a particular year called base year, it is known as GDP at constant price or real GDP. So the difference between nominal GDP and real GDP is that in case of real GDP, we are taking out the inflationary component and we are only looking at the real prices. So inflation is not included in the real GDP. But in case of current GDP at current price or nominal GDP, inflation component exists. And remember, when we are comparing the GDP over a time period, we can only compare if it is adjusted for the inflation, because that means when we are comparing the growth rate of say GDP from 1950 to 2020, then we should compare only the constant GDP. We should not estimate the growth rate using the nominal GDP. If at all you are doing that, then we should tell that this is the nominal growth, and the nominal growth will be much higher than the real growth that has happened in the GDP. Now comes the production, what are included and excluded in the GDP. Now I should start with the things that are excluded in the GDP estimation. Now the service production in the household by the household members for their own consumption is excluded from the GDP. That means suppose the mother teaches the child in the family, then we do not include that service. But if you hire a tutor for our children for their education, we give money, then that will be included in the GDP. And similarly, if you are hiring a nurse to take care of your baby or your parents or anybody in the family, then you are paying some in money to the nurse, and so that will be included in the GDP. But if we are taking care of our own children or our own parents, then that service will not be accounted for in the GDP. And that is why it is a joke is used in the GDP estimation that if somebody marries the domestic help, then the GDP will collapse. Why? Because if you are if you are using a domestic help and you are paying some money to him or her, then that comes in the national income accounting. But if you marry the domestic help and you don't have to pay anything, then the GDP value will go down. So that is the joke we use in the GDP estimation. But you should know that uh, whatever the production, whatever activities that are included are basically based on the national industrial classification, or we can say that international standard industrial classification. So GDP covers all the production activities recognized by the United Nations System of National Accounts, that is called production boundary. And then at national level, we have a national industrial classification, that is, say, for example, agriculture, mining, construction. So what all activity will be, how you are classifying the activities, that is decided by the national industrial classification. So for example, within agriculture and allied activities, we have agriculture, we have fishery, we have livestock, we have forestry. Similarly, within say industry sector, we have registered manufacturing, unregistered manufacturing, we have construction, electricity, water, drinking water, and gas supply. So like that, we have national industrial classification codes. Now, when we collect the data, we collect the data under that particular category, depending upon this classification, and then we aggregate the output, and that's how we get the GDP or the gross value addition that has happened. Now, if you want to see the sectoral production, then you have to use this national industrial classification, and you can aggregate to get the value addition that happens in a particular sector, or you can say the sectoral GDP. Now, next one is production of agriculture, forestry, fishing, which are all used for own consumption, are also included in the production boundary. But remember, so if you are producing something and consuming on your own, then that is included. But all the services produced in the home and delivered to your family members are not included. If you are hiring a cook, then you have to pay money, then that is included in GDP. But if you are cooking on your own, then that service is not accounted for in the GDP. Now, similarly, the rental value of the buildings are included in the GDP calculation, and your own account construction activities are also included in the GDP. Now, coming to the national income, usually, in every discussion we use national income. So, GDP is nothing but the sum of the income of the employees and the producer unit. So GDP, also can be measured in different ways. One could be production method, one could be income method, and other could be the expenditure method. Now, GDP is summation of all the value addition, that is a production method. Similarly, GDP could be summation of all the income of employees and the producer unit. So that could be GDP, using the income method. Similarly, all the expenditures that happens in the country, then if you aggregate that also, that will be basically the national GDP. And so GDP can be obtained by adding up the income earned by the employees, and you add the tax and deduct the subsidies paid to the government, and operating surplus you have to add, then operating surplus held by the producer. So if you aggregate all this, then you get GDP. So GDP again is basically the summation of all the income earned by the employees and all the operating surplus held by the producer unit plus the taxes and minus the subsidies. However, there is some income received by the economy from the rest of the world on account of salaries and wages of resident working abroad and property income. That means, say, many of our Indians say work abroad, and they send remittances to India. And whether we will be including that in our GDP calculation or not. Similarly, lot of Indian companies are operating in other countries. They are investing in capital in other countries. They get a lot of income, basically profit. They repatriate the profit to India. Similarly, a lot of foreign companies operate in India, and they send the profit to their country. They repatriate the profit to their country. A lot of foreigners work in India. They send the remittances to their country. Whether these will be included in GDP or national income or not, let us discuss on those issues. And for your information, India receives the highest amount of remittances in the world from other countries. Earlier it was China, but now it is Indians who send maximum amount of remittances to India. Now, if you see, there is some outflow. Okay, I told you that. Now, a measure of the overall income of the economy obtained by adding net compensation of employees and property income received from the rest of the world is termed as gross national income. So that means in the gross domestic product, we looked at only the gross value addition that is happening within the national boundary. We did not include the remittances that we receive. We did not include the income, the profit that is coming from the foreign, from the Indian companies operating abroad. So now, if we want to include that, then we have to use the indicator that is gross national income, in which we are taking the gross value addition plus the income obtained by uh, the obtained basically all the compensation of the employees and property income. That means all the remittances that comes from abroad, okay, and similarly all the profits that is repatriated by the Indian companies from abroad, and then similarly we have to deduct all the income that is going out from our country. Similarly, we have to deduct all the profits that is repatriated from our country. So that means your gross national income is basically obtained by adding the net consumption of employees and property income received from the rest of the world. Okay, that is actually basically gross national income. So GDP and GNI, that is gross national income and gross domestic product, will be coterminous in a closed economy. Now, when I say closed economy, that means we are not having any trade relationship with any other country. Similarly, our people, Indians, do not work abroad. They do not send any kind of remittances. Our companies do not go to foreign countries to do any kind of investment. That's why they do not send any profit to our country. Similarly, foreign companies do not operate in India. Foreigners do not work in India. So that will be a closed economy. So if that is the situation, gross national income and gross domestic product will be same. But in reality, India is not a closed economy. In fact, starting from 1947, India was never a fully closed economy. We had some restriction on the export and import up to say 90s, 1990s. After that, we have opened up, but it was not a completely closed economy. We had trade relationship with other countries, but the export and imports were very much limited because we had limited foreign exchange. And then we can also derive the net national income. To derive the net national income, you have to deduct the depreciation. And so whenever we are talking about national income, it refers to the net national income. That means gross national income minus the depreciation, or we can say minus the consumption of fixed capital, then we get the net national income, which in simple language we use this as national income of the country. Now some more concepts: primary income and transfer income. Now what are the primary incomes? Primary incomes are basically the compensation of employees, then the operating surplus or the profits, and then all the taxes and minor subsidies on products which accrue by the way of factory income and income due to ownership of assets. So primary income is basically your compensation of employees, then the operating surplus of the profits, and tax minus subsidies on products which accrue by the way of factor income and income due to ownership of asset, that is known as primary income. So either you are working as a labor, or you are working as a professional, or you are investing the capital and you are getting the return on the capital, and then the taxes minus subsidies. These are basically the primary incomes. But on the other hand, for transfer incomes, you are basically not working anything. You are getting some benefit or financial assistance by somebody else. So it is basically the income in the form of old age pensions, grants for education, unemployment allowance, then gifts, all the direct taxes, and life insurance premium. These are basically the payments for current. These are not payments for current services or production. They are paid out of the primary income. So these are, you are not getting old age pension because you are working now. You are not getting education grants because no, you have given something. So you are just getting from somebody, and this is paid out of the primary income. Somebody is paying tax, and that's how we are getting the benefits. So transfer incomes are basically coming as a transfer from somebody else, where you have not really contributed anything. You have not worked, or you have not invested anything, and that's so, but you are getting some benefits. So receipts for which nothing is paid in return are transfer incomes, and these are secondary incomes obtained as a result of distribution of primary income. Next, we can discuss the expenditure method. How I told that product income, national income can be estimated through production method, through income method, through expenditure method. Production method, that is gross value addition in different sectors. You put together, that is gross value addition. And you deduct the depreciation, then you get net domestic product. Now, you can also use the expenditure method to estimate the GDP. Now let us discuss that. The total availability of goods and services during the reference year period is the sum of initial stocks, production, and so initial stock plus production and imports. That will be the basically the total availability of goods and services in a particular year. Initial stock plus production plus import. That is basically the total availability of goods and services. Now these are used as intermediate consumption, final consumption, and gross fixed capital formation, export, and remaining ends up as final stock. It means some of these outputs can be used as intermediate consumption, some things can be used as final consumption, and something can be used for the further production, that is gross fixed capital formation. Some things will be exported, and whatever is left out, it is called as the final stock. So now, if just we can arrange this in equation form or identity, that we call. So SI plus P plus I, that is the initial stock, plus the production plus the import, is equal to initial consumption, and then we have final consumption, or say the intermediate consumption, not initial consumption, it is intermediate consumption plus the final consumption, gross fixed capital formation plus export plus the final stock. So that means whatever we have produced, that means initial stock plus the production plus the import. So that is the stock we have. Then that can be either used as intermediate consumption or the inputs. That can be used as the final consumption. That means we completely enjoy this to eat away. Or we can say that gross fixed capital formation, that is basically the further addition to the capital that we are doing. Or it is basically the export that we are doing. And if something is left out, then that is known as the final stock. And all can be measured at market prices. So if you rewrite the equation, we will get P minus IC. That means we are taking IC from right side to left side. So production minus intermediate consumption, that is nothing but the GDP, gross domestic product, is equal to FC, that is final consumption, plus gross fixed capital formation, plus the final stock minus the initial stock, that means change in the stock, that we can say, plus net export, that is export minus import. So it is nothing but GDP is equal to final consumption plus gross fixed capital formation plus change in stock plus net export. And that's how we can estimate GDP by adding up the use or the expenditure components. So that means GDP also can be estimated by using the expenditure method on different things, on final consumption, on gross fixed capital formation, on change in stock, and on net exports. Now, these are the methods, that is GDP can be estimated through production method, income method, or expenditure method. Now coming to the first one, that is GDP of a country, can be measured in three ways, that is from the production angle, from the income generation angle, and from final utilization. So these are basically these three forms are circular in nature, because see, now if the producer is producing certain things, then suppose it is using, if in a two sector model, you can say that if there are households and there are only manufacturers or the firms, then the household is selling the factors of production like labor to the household, to the farm, and then farm is producing output. So in return, it is paying the wage to the household. Now, household is using that income for buying the commodities from the farm. So that means farm is paying to the household and household is also paying to the farm. So the circular chain is completed. That is why now we can say that to get the national income, we can use the production method, we can use the income method, or we can use the expenditure method. Now that's why these are circular in nature. So it begins as the production. It begins at the production stage where the productive units engage capital, labor, and turn out goods and services, and total measures of which is gives us GDP. Now, in the second phase, the production process generates a given amount of money income, which is distributed by the productive units to capital and labor, and the measures of income this way indicates the share of GDP to the employees and entrepreneurs. And then the third one will be expenditure. So the income thus received by the factors of production is then spent either by the employees in their capacity as households in terms of acquisition and consumption of goods and services, or by the entrepreneurs in acquiring more capital and thus increasing the physical assets of their production units. So that means we are producing income, then when we are paying the money to somebody else, that becomes income. That income is spent by the households and different firms, so that becomes expenditure. And if you aggregate either the output, total output, and or the income or the expenditure, you will get the national income. So production is equal to distribution is equal to disposition or the expenditure. And so GDP is the same whether it is measured at the point of production or at the point of income generation or at the point of final utilization or the expenditure. In other words, the value of production is equal to income flows and final expenditure. So these will be all identical. And the significance of each arises from the fact that they reflect total operations of the economy at the levels of three basic economic functions, namely production, distribution, and disposition. So basically, now we can estimate GDP through production, income, and expenditure method. Now coming to the first method, just a repetition and in a little elaborative manner, the production method. So first of all, we have to divide the entire economy into different economic activities based on the national industrial classification or the international industrial classification. And then we estimate the total value of output and the corresponding value of input of raw materials and services used for production. Then we arrive at the value addition by taking the total output, value of output, minus the value of the inputs. So we get the value addition in each sector. And then in the case of services, value added is measured in terms of the total amount of money paid in return for the services received minus the cost of inputs like the expenditure on transport, advertisement, and other miscellaneous services used for the production of the service. For example, if a doctor is giving the service of healthcare, then whatever money we receive for the healthcare, that will be the total value of the service production. But for producing that service, we are having a lot of expenditure, like we are employing doctor, we are employing nurses, we are buying different machineries, we are using different inputs. So that expenditure, all the operation or maintenance expenditure will be deducted from the total value that we receive from the sale of the healthcare. Then we get the total value addition in the health sector. So that means now first, so for the production method estimation of GDP, what we do? We first divide all the sectors into different groups based on the national industrial classification. We get the value addition in every sector, and then to get the value addition, we deduct the inputs from the total value of output. And if you aggregate all the production in different sectors, then that is called as GDP. That is estimated in using the production method. Then the second method will be the income method. Now, in the income method, what we do, so when we do the production, the income is distributed between two primary inputs, namely capital and the labor. And so income is distributed either in the form of capital income to the owner of the capital, or labor income to the labor employed. And thus, the total income generated in the form of factors here consists of wage and salary, interest, rent, dividend, undistributed profits, and mixed income of self-employed. So if you aggregate all the incomes, like in different forms, wage and salary, interest payments, rent and dividends, and then undistributed profit, then mixed income of self-employed, then that will be basically GDP estimated using the income method. Then the final method, that is GDP estimation using the expenditure method. Now for that, you'll have to take the four forms of expenditure. Either you do the household consumption, so it includes the private final consumption expenditure, but it excludes the land and buildings purchased by the households. These are not part of the private final consumption because these are estimated under the capital formation. So the first form of expenditure will be household consumption, private final consumption expenditure. Then comes government consumption. So how do you estimate the government consumption? You basically take the total expenditure of the government, that is government's consumption. And then comes the capital formation, that includes the fixed capital formation and stock accumulation. And the gross fixed capital formation consists of the gross fixed capital formation and changes in the stock of inventories. So in gross fixed capital formation, we take the lands, building, the machineries, and we also include the changes in the inventories, that is gross fixed capital formation. And then we take the net export, that is export minus import. So basically, if you add all these things, household consumption, government consumption, capital formation, and net export, then we get also the GDP using the expenditure method. So to sum up all these things, you can write it in equation form. So the gross value addition at factor cost is equal to output minus the intermediate consumption. Then gross domestic product at factor cost is also equal to sum of the gross value addition at factor cost. Then GDP at market price is nothing but GDP at factor cost plus taxes minus subsidies on production and export or import. That is also equal to the final consumption expenditure plus the consumption in inventories and gross fixed capital formation plus acquisition minus the disposable values plus exports of goods and services minus the imports of goods and services. So that is basically the expenditure method. And then we can take the income method, that is compensation of employees plus the operating surplus or the mixed income plus consumption of fixed capital formation plus taxes minus subsidies on production and export and import. So that means we are basically estimating the first one, that is GDP at factor cost plus taxes minus subsidies on production and export and import, that is GDP estimated using the production method. In the second one, this component final consumption expenditure, changes in inventories, gross fixed capital formation, acquisition minus disposable of values, export of goods and services minus import of goods and services. These are basically the expenditure method. And then third one, compensation of employees, plus the operating surplus or mixed income from the self-employment, then consumption of fixed capital formation and fixed capital, and then plus taxes minus subsidies on production and export and import is basically the income method. And net domestic product at factor cost or market price can be deducted by deducting the consumption of fixed capital from the GDP at factor cost or the market prices. Similarly, if you look at the income and saving identities, then gross national income at market price is equal to GDP at market price plus the taxes minus subsidies on production and imports plus the compensation of employees and net receivable from the abroad, and plus property income net receivable from the abroad. That means basically the income that we receive from foreign, from the Indians working in other countries minus the foreigners working in India who send the income to other countries. Property income, basically the Indians repatriate profit from other country wherever they are doing investment. Similarly, the foreign direct investment who are doing investment in India, they send the profit to other countries, to their countries. So that will be basically the net receivable from abroad. So in Indian context, in the second comment, that is compensation of employees, we receive net, but in property income we pay more than we receive. And then we get net national income at market price, that is gross national income at market price minus the depreciation or consumption of fixed capital. Then net national disposable income, NNDI, that is net national income plus net taxes on income and wealth receivable from abroad plus net social contributions and benefits received from abroad, receivable from abroad, that is net national disposable income. So that is basically here we are including the taxes, and the net saving is equal to net national domestic income minus final consumption expenditure plus net equity of households and pension funds receivable from abroad plus net capital transfers available. So the changes in net worth due to saving and capital transfers is equal to net saving plus capital transfers receivable. And again, some more identities, saving and investment identities. Net saving plus net capital transfers receivable is equal to gross fixed capital formation minus the consumption of fixed capital or depreciation plus changes in the inventories plus acquisition minus disposable of valuables and non-produced non-financial assets plus net lending or the net borrowing. And then net lending is equal to net acquisition of financial assets less the net incurrence of financial liabilities. So these are some of the identities, but those are not used in day-to-day life. Now, for GDP estimation, I told you in the beginning that we are using a base year to estimate the real GDP or the GDP at constant price. Now, when we estimated the GDP for the first time after India's independence, it was PC Mahalanobis, headed, basically he headed a committee on national income, and then the income that we estimated for the first time, we used the base year 1948-49. But then onwards, we have changed the base year from time to time, and so we moved from 1948-49 to 1960-61, then 70-71, 80-81. That was initially, we maintained 10 years interval almost, and then we changed it to 93-94, then 99, 2000, and 2011-12. So the present GDP that we are estimating, we are using a base year of 2011-12 to estimate the constant GDP or the real GDP. And so base year, basically you have to choose a normal year where there will be no major fluctuation in the output. Basically monsoon has to be good so that agricultural output remains good, and similarly there will be no war, there will be no major disasters, so that no output is not badly affected. Similarly the petroleum prices should be normal. So overall the prices, has to remain moderate, and then output also has to be satisfactory. Then only we take that year as a base year. And presently we are using the base year of 2011-12. So this is all about the different concepts of national income accounting. I have used basically the manual provided by the National Account Statistics, sources and methods, published in 2012. All of you can visit the CSO website, that is mospi.nic.in, and you can download this report from Google also. So if you want to know more about GDP estimation, please go through this report. Thank you very much for watching this video, and if you like, you may subscribe this channel for getting the updates on next videos. Thank you very much.